Hello, I hope everyone's having a great day today. My name is Max Convexity. Thanks for tuning into my channel. I have a great video planned for you today. We're going to look at some new funds that got released. Just seen on Twitter yesterday that there is some new funds from GraniteShares out. The tickers are YSPY, and YSPY's been out for about a week or two, and YQQY. And I'm not actually sure if YQQY started trading yet. If it has, I haven't seen it, but I think it's going to start any day now. Probably it started yesterday or today. I probably just didn't catch it. All right, GraniteShares. So GraniteShares, I believe their founder is a guy named Will Ryan. Now, Will has been on the show before, and he is the definition of a heavy hitter. He's right up there with Mike Venuto from Tidal, and of course, Tidal's the team behind YieldMax. But according to ETFdatabase.com, Will down there at GraniteShares has brought $7.8 billion under management in the past year, which is incredible. Just for comparison purposes, Mike over at YieldMax has raised about $11 billion, but YieldMax has been they've both been incredibly successful companies, and they're both, in my opinion, good representatives of the liquid alt and the alternative ETF business. All right, so let's just look at YSPY since it's been out today. Let's go to the prospectus, and then maybe we'll go to the backtester and backtest a couple of their strategies. Maybe if you aren't into that kind of stuff, fast forward to the end and you can catch my conclusion. Okay, so here we have the website. So that they have it's GraniteShares, but they're called Yield Boost products. So they're Yield Boost products. There's three of them. There's TSYY, there's YSPY, and there's TQQY. Now, TSYY has been out the longest of any of them. And I just usually prefer talking about index products, but TSYY is a high yield single stock based product. Darn it, based on Tesla, or it competes with Tesla from YieldMax. Well, it's comparing pretty darn favorably to Tesla at YieldMax. This fund, TSYY, was almost looking like it was magic for a while last year, because even though Tesla was losing ground, TSYY was going straight sideways, but then TSYY came back to earth. In any event, they're both, getting hurt pretty bad, but TSYY, by comparison, is doing comparatively better. All right, so that's their single stock product, but today we're here to talk about their index product, because you know how I am about my index funds. Now, one other thing I've noticed is, yes, I guess TQQY has started trading because they have 600,000 under management. TSYY has $1.5 million under management, and YSPY has 667,000 under management. So these funds are tiny at this point, and given how well TSYY is doing compared to some of the competition, I'm a little bit surprised. Okay, so here was the product overview. Says the fund's objective is to seek current income, but the fund's secondary investment objective is to seek exposure to the performance of one or more exchange traded funds, and that's the important part, in my opinion, because they're seeking leveraged performance to leverage Tesla performance. We'll get into that when we get to the prospectus. Let's look at the prospectus now. First of all, here's their other ones they've proposed to come out with. They have one called RYY, which is going to be a Russell based. Now, it's not out yet. Then evidently they're planning on coming out with one called Finny, one called Nuggy, that's gold miners, one called Semi, whatever, SEMY, Techie. Anyway, should be interesting. The ones we know about now is the Tesla-based one, TSYY, and the top two, TQQY and YSPY. All right, let's start here. This looks like some kind of addendum to the prospectus. I just caught this. They probably did this when the market started going down. Effective immediately, each fund's investment strategy will allow for selling put spreads. Something I've told Jason since day one. They should have done at Defiance, but they don't pay me to make decisions, and they've done a pretty good job at Defiance. I don't think Sylvia is worried about anything. It's a great company. But I think they should, instead of just exactly what this says, instead of solely selling put options, sell some put spreads occasionally. It's more defensive. Anyway, so they made an addendum to this. The fund is an actively managed exchange-traded ETF that seeks current income while maintaining the opportunity for indirect exposure to the share price of the ProShares Ultra Pro Qs, which is TQQQ. Subject to limit on potential gains from an increase in the price of the underlying ETF share. The fund will seek to employ its investment strategy as it relates to the underlying ETF, regardless of whether there's periods of adverse market conditions. Okay, so that's pretty much boilerplate. The fund will sell put option contracts, either directly or through swap contracts on the underlying ETF. So this fund is going to sell puts on the TQQQ, which is triple leveraged. So, and what do we know about selling a put? Well, what do we know about buying a put? When you buy a put, you're bearish. So when you sell a put, it's a bullish play. Okay, so they're going to be selling puts. So making bullish plays on triple leveraged NASDAQ. What's not to like? As long as NASDAQ goes up, right? So it says the fund's participation potential increase in the price of the underlying only applies, and this is important, if the fund sells an in-the-money put option contract. There's a lot of you guys that are in love with out-of-the-money put option contracts, but an in-the-money put option contract's a beautiful thing. It's the way they do it at Defiance, and it allows you to catch upside. In fact, when Will was on the show, I said something to him. I bet he changed the prospectus because of me. They probably went back and researched it, but the put option contracts sold by the fund may vary regarding strike price from 40% out of the money to 10% in the money, maturity from 1 week to 1 month. So this fund has left themselves a lot of room to manage, and we'll kind of see that in the back test. So they have three kind of examples. So with digging too in the weeds, the first one, they're just going to sell a put option with 1 month to maturity. Okay, so here we have it, TQQQ. Let's do a new back test. So all we're going to do, it's so easy to back test this. 1 month to maturity, and it said selling a put option. That is so easy. Now, we're going to do an in-the-money put option, and we're going to test it over the past 2 years. Now, in-the-money put option is that was buying a put. That's the opposite of what we want to do. We're monetizing by selling to that guy. It's interesting to look at that. This is the guy we're selling it to. And this guy loves to buy puts because you can see his account balance went from down 3,200 to only down 7. So he made about $3,000 in a couple of days because he's buying a put option. But you can see you have a constant bleed when you buy put options. You can see kind of by the way the chart's moving. Okay, so if we were to back test this selling the put option, which is what we're supposed to do, this is for the past 2 years. How do you think we would have come out? And this is the in-the-money put option. All right, so right here at the bottom left, buy and hold would have netted you 3,500. Doing it this way outperformed buy and hold over the past 2 years. 4,100. Now the bad thing is max drawdown was 51% using the option strategy, where if you would have used stocks, you would have had a smaller max drawdown. You get a little bit higher return, smaller max drawdowns. So this is, a tough call. Return on used capital, the option strategy was 229%. We're just buying and holding the stock was 195%. Now we have to look at the details to see the reason we do this right here is this average premium. This is how much each option on average brings in. So it brings in $467 to sell the option. Well, by the time you subtract your losses out, you make about 200. You get about 44% of that. Okay, so this trade tied up $4,100 of capital, but it brought in about $9,300 of premium. But that's over 2 years though. But so that's about 100% a year. I mean, that's a lot of premium. That's a lot of premium. Okay, so that's also, and the way you do it this way, they got a lot of upside because it was an in the money option. Now watch, if I go to an out of the money option, which is the way most people want to do it, it's the way they started off doing it, and I guess that's fine too. But you go to an out of the money option, you're sacrificing a lot of the upside. So this way, your total profit was $1,800, where buy and hold was $2,800. Return on used capital, you made a little less than buy and hold. And even though it's now the money option, you still got killed in August of this year. But other than that, you're real steady. A lot of people like selling out of the money options. Is like getting up there and bunting every time in baseball, or hitting, especially if the defense had never seen you bat before and they weren't expecting you to bunt. But you could just do that every time. That's all it is. You're going to get a single lots of the time. But anyway, all right. Well, but so that's the out of the money strategy. But these guys, what I take from the Prospectus, sometimes they're going to do out of the money, sometimes they're going to do at the money. They can also vary the timeliness. Like, do they sell it with 30 days left, or do they sell it with 7 days left? That makes a big difference too. I don't want to bore you guys with that, so we aren't even going to get into the weeds on that. Let's go back to the darn Prospectus. Okay, so strategy number 2 was selling an out of the money put contract with 1 week. Well, I basically did that, but I mean, the 1 week was a good idea. Let's look at that real quick. Strike. Okay, so let's do 7 days till expiration. Run back test. And we forgot to check. Well, and also this time let's check the yield. Like I always say, the only reason people do these kinds of strategies is for the income. Like you could see, this one's costing you NAV. This strategy, selling weeklies over the past 2 years in this time cycle, is bleeding NAV. But let me show you why you do it. It's under details right here. Average premium $47. Average premium of $4,300 on 2,000 used capital. It's about these strategies are making about 100% a year in the back tester. Now, what they're going to do in real life, and I don't know if he's going to use the 20 strike or the 30 strike, or if he's going to vary it or whatnot, but that's what an out of the money strategy gets you with 1 week to maturity. But there's certain times that they want to do that. When we get Will back on the show, we'll ask him what time they do what. But I would imagine example 2 is more defensive. They use the out of the money contracts, the shorter maturity when the market's dicier, and when the market's going well, they use the 1 month, in the money. That's your money. That's your money maker in the nut market, I bet you. Okay, so they also have a strategy 3 in here. There's strategy 3, defensive strategy, selling at the money put option contracts and buying an out of the money put option contract with 1 month to maturity. Selling at the money. At the money is a good one to sell too, just right at the money. But and then buying, I still like in the money, but and then buying an out of the money put option contract. So let me show you how that one works. In theory, how it would work. Okay, and I think that's what this other tab was, because so it's selling selling an at the money, so we'll call it 50, and then selling an at the money put, which is bullish, but then at the same time buying an out of the money put, which is bearish. And you wouldn't normally want to bet against yourself, but maybe they're thinking they can cut their cut big losses. So what we're going to do is we'll do this in the 30-day time frame, and we'll compare, just to make apples to apples, we're going to compare it to the selling the in the money 60 delta option. We're going to look at that, but then we're going to look at doing that at the same time as buying an out of the money option and see how that does. So back to the selling the in the money option 30 days out. First test we did. I'm going to bring it back up. It did very well. It outperformed buy and hold. It did great. Okay. Yeah. 229% instead of 195%. It outperformed buy and hold, just to refresh everyone's memory. And it generated $9,000 premium on only $2,000 or only $1,700 used capital. That's over 2 years, but I mean, it's like 300 or 400%. It's great. It's this is an insane back test. And this is the reason for the fund. That's an insane back test. Okay. So that's our comparison. So here's strategy number 3. And with the caveat, I don't know the strikes, but I'm just taking what the prospectus is. So same thing on the bullish side. We're going to sell the bullish put option, sell that in the money put option. But on the bearish side, we're going to buy an out of the money put option just to kind of cut our max loss. Well, let's see how it works. I bet it doesn't work as well as the other way. It's just doing it naked. It's not buying protection, but I could be wrong. Buying protection usually backtests poorly. It usually bleeds money like crazy. Now, this backtest went back 5 years. I didn't mean to do that. Gosh darn it. Let's hit cancel. Okay, so let's just go back 2 years. Let's see how the more defensive. So this is strategy number 3. I'm still saying strategy number 2 is going to be the best, but this strategy underperformed a little bit. And of course it did, because we're spending money buying the stupid put. Now, it does make our max drawdown a little less. Look, max drawdown was only 40%. But, stocks was only 37. So that's pretty good when you're the same as stocks. I mean, this is a good back test too, because you cut off a lot of your downside. On the other test, this way, your max drawdown was your max drawdown was 51%. Okay, but this one had a bigger max drawdown, but it also had a little better total performance. What's the only reason we do these funds? Only if we need income. These would be silly to mess with if you weren't doing something with the income, either just reinvesting part of it, paying a credit card, paying yourself something. I mean, these are crazy strategies without needing the income and using it. So if we needed the income, let's see which way would be better. All right, the way without protection, strategy number 1, we'll look at the details. Tons of average premium. This is a great strategy. $9,000 premium on $2,000. We don't even need that much. It's like 400% or something. Okay, so the way with protection, it's going to be a little bit less, but let's see how much less. Let's go to details. And yeah, the average premium per trade is $355 instead of like $424, because we're spending $75 on each option approximately. Well, it takes down their average profit per trade, blah, blah, blah. But it also takes down the total premium we capture in 2 years to $7,000 on $1,700. It's still really good. This is an incredible back test. I'm going to buy this. I'm going to buy this today, at least a starter position. But this thing's going to be incredible. And you can look at how TSYY did compared to TSLY, how much better it did in a down market. But what I mainly care about is the down market performance. That's why I've always liked to finance in the funds with the big buffer. I like a big buffer. So, I don't know. This fund I'm definitely going to take a starter position in it just to get going. So those are the 2 strategies. I just wanted to be able to compare these 2 strategies to each other. So that's why I wanted to sell the same. It's a long story. Okay. Well, I think we have a pretty good idea of how these funds are going to perform. I think they're going to use a strategy number one, just selling a put option, in the money put option in a full bullish market. And then they have a strategy number two, which is selling a put spread. They'll probably do that in a more, or they made an addendum where it says they're able to sell put spreads. And I bet they'll do that. I bet they'll do that in a little bit more defensive situation. But then in the most defensive situation, they might actually also buy a put to cut off some of that downside. And you can see in theory that works. I mean, no one wants a fund that's down 50% in a year or 57% or whatever that one was down. But the fund that was down 41% when heck, the SPY was down 37 or the Qs were down 37%. You're talking the same volatility as stocks, so that would have more of a place in some people's portfolios, I believe. Yeah, supply. Of course, I've said this like 3 other times in here. Don't use any of these yielding ETFs unless you need a yield. That's why they're high yield, especially the high yield ones are for people that need a high yield. And a lot of people don't need a high yield. They may think they do, but they don't. And I'm thinking of the wealthier people. But in any event, these funds can, even for wealthy people, even the high yield funds can serve as great diversifiers or could work as part of a portfolio. But if you don't need income, I wouldn't touch these. Like I said, I'm going to take a starter position in probably all 3 of these. There's 2 of them out right now, but I'm going to take a starter position. We'll see where it goes and start monitoring it. But based on the back test and based on my prior conversations with Will, and we had addressed this same topic, because I said, why are you selling out of the money? At the time, the prospectus only had out of the money, and it didn't allow for put spreads. And I was trying to tell him to sell in the money, and he was not hearing any of it. He didn't want to. He liked his out of the money strategy, and out of the money strategy is a great strategy. It's real steady and consistent. But for whatever reason, it has nothing to do with talking to me. But for whatever reason, maybe listening to feedback, or maybe he saw that back test, because it back tests better to do it, the way I suggested. But in any event, it's like I say, it's not that he didn't know that already. Also, you can't teach these guys anything. Will's a heavy hitter. So if you like these types of videos, maybe give me a follow, maybe check out my Discord. We talk all day long about these ETFs, and not only these ETFs, but the option strategies behind them and why they should work or why they aren't working or when they should start working again, all that kind of stuff. We kind of approach things on my Discord and on this channel more from an option trader standpoint. So in the high yield space, I think it's essential to have a deep understanding, not only of options, but really the option strategies, systematic option strategies, more like hedge funds do. But it's a real advantage if you have a little bit of knowledge in that area to figure out how these ETFs might perform. I've always had the shot callers on the station, people like Jay, people like Mike Venuto from Tidal Financial, for that matter. But Will from GraniteShares, he's something else also. Yet to have a marketer on my program. That's my program focuses on the options. I want to know the strikes, the nitty gritty, how many days till expiration, all that kind of stuff. So anyway, if you like that kind of stuff, keep following my content. And if you don't like that kind of stuff, you definitely won't like my content. But thank you for watching anyway today. All right, guys, I appreciate you. Have a good day.